We're going to talk about IASB Conceptual Framework. Now, the nature of this framework, this is principle-based framework. As it is a principle-based framework, this is theoretical in nature. What is the nature? Yes, theoretical in nature. So, if something is theoretical in nature, practical application is limited because this is theoretical in nature, right? Practical application is limited. However, this framework has high level of practical objective or purpose, aim, practical goal, right? High level of practical objectives. So this framework is basically the foundation of IAS IFRSs. IAS IFRSs take the basic principles, definitions, etc. from this framework. IAS IFRS, we can give example. These are like buildings, but under building there is the foundation, and foundation is this framework, right? So we need first framework, and then we will construct the buildings. Those are IAS IFRSs, individual IAS IFRSs. Right. Also, this framework is going to provide you guidelines where standards are silent. Say, for example, if you're facing a weird type of transaction in your practical life, you are an accountant. There is no solution for that transaction in a specific IAS IFRSs. You need to go back to the framework, right? Then you need to apply your own professional judgment, and you need to try to find out a solution. You need to make a decision, right? That's your job. Now, these are the contents of the framework. First content is purpose and status. Then objective of general purpose financial reporting, qualitative characteristics, financial statements and reporting entities, elements of financial statements, recognition and derecognition is covered, measurement is covered, and presentation disclosure, finally capital and capital maintenance. These are the contents of the framework, right? At home, you will memorize this list. Framework is not complicated because this provides just the basic thing, okay? Just the basic. IAS IFRS will provide you detailed guideline regarding a specific transaction, specific items. But framework just provides the basic thing, basic recognition, basic measurement, right? It doesn't tell you how to recognize intangible asset. That is covered by a specific IAS 38. How to recognize provision, framework doesn't tell you that. Basic recognition, that's it. Okay. Now, first thing that is provided by our framework is the purpose, right? What is the purpose of framework? Basically, the purpose of framework is to assist various parties. What are those parties? Standard setters, financial statement preparers, and other interested parties, right? This framework is going to assist. So first of all, there is standard setters. International Accounting Standard Board, IASB, that prepares IAS IFRS, that is the standard setters. Also, we have local standard setters, right? Bangladesh can try to develop its own BAS if it likes. So this framework is going to assist both IASB and other local standard setters. It will provide the basic elements. You can develop your own IAS IFRS based on these basic principles. It will be consistent, right? It will be harmonized. Okay? Fine. Then financial statement preparers, accountants, right? Definitions, basic recognition, measurement. These ideas are provided by the framework, right? But you have detailed IAS IFRSs. You will mostly follow detailed IAS IFRSs. However, sometimes there will be some gaps or omissions in IAS IFRSs. You will come back to framework right? And apply framework. And framework also will help you to apply accounting policies on consistent basis, right? Also, sometimes you will face there are multiple options. You can go either this way or that way, right? Say, for example, property, plant, and equipment. You can measure property, plant, and equipment using historical cost basis or fair value basis. Which policy to choose? Framework is going to help you on that particular issue. Other interested parties, framework is going to help other interested parties so that they understand IAS IFRSs better. They can apply IAS IFRSs in their relevant sector, right? So the main purpose is to assist various parties. Who are the main focus groups? Standard setters. Number two, financial statement preparers, other interested parties. That's very good. The second thing that is provided by the framework is status of the framework. You need to understand that this framework doesn't have any regulatory authority, right? You are not bound by this framework as an accountant. No legal power over you, okay? Clear, guys? Now, you have the framework, also you have IAS IFRSs. Normally, IAS IFRSs will be consistent with framework. Both will be similar, right? No authority over you, no legal power over you. You are not bound by this framework, okay? This is basically principles, not law. If you do not follow framework, you will not be punished. That's the simplest thing. If you do not comply with IAS IFRS, then under Security Exchange Commission's rules and regulations, you will be punished. But like IASB cannot enforce framework on them. Okay, you can have local regulations, stock exchange regulations. Under those stock exchange regulations, government rules, you will be punished. Okay. So do not assume this is law. This is not law. Right? This is yes, guideline principles, theoretical in nature. Now, we were talking about consistency between the framework and IAS IFRSs. IAS IFRSs are made based on the framework, so IAS IFRSs are normally consistent with the framework. However, in some situations, we may find that IAS IFRSs are contradicting with the framework, right? Not following the principles of the framework, right? In that case, which one will have higher priority? IAS IFRS will have higher priority. You follow IAS IFRS, even if it non-compliant with the framework, doesn't matter. So it has lower status. You understand that already, right? Yeah? Good. Then the next content of framework. What is the objective of general purpose financial reporting? Okay. So the main objective of general purpose financial reporting is to provide useful information to investors and potential investors. Focus group, investors and potential investors. That's the focus group. Example of investors and potential investors: shareholder, lenders, and other creditors. Right? So what is our focus group, guys? Investors and potential investors. Example, shareholders. Yeah. So we are providing useful information. What is the purpose of useful information? They will make decision. What kind of decision these investors and potential investors will make? regarding providing resources to the entity. What kind of resource they provide? Capital, right? Equity capital and debt capital, or even trade credit, right? So they are going to make decision. What kind of decision? Whether to provide resource or not, whether to invest in this entity or not. That kind of decision they are going to make. Okay. So that is the main objective. Also, it has other focus. One of the significant focus is to provide information to those groups, investors and potential investors once again, so that they can assess management's stewardship. What? Management's stewardship. They can assess management stewardship over the company's asset. So what is management's stewardship?
ইনভেস্টরদের ক্যাপিটাল ঠিকমতো ম্যানেজ করতে পারছে
কিনা, চুরি করছে নাকি ঠিকমতো দেখভাল করছে, right? That is the job of stewardship. Yeah, of course, right? আমি টাকা দিলাম, ম্যানেজমেন্ট এটা প্রপারলি ম্যানেজ করছে কিনা, নাকি চুরি করছে নাকি নষ্ট করছে, এটসেট্রা এটসেট্রা, right? Okay. Also, we are going to provide information regarding economic resources of an entity, right? Economic resource. What is economic resource? In plain terms, those are assets. Then claims over the entity's economic resource. What is that? In simple terms, those are claims on the economic resource of the entity. What is that in simple terms? Economic resource in simple term is asset. Claim, other parties claim. That is what that is. Liability basically, right? Liability basically. Okay. Huh? Sorry. Economic resource. Economic resource in simple term, that is asset. Provide information about the assets of the entity. Okay. The second one is claim. What is claim? Liabilities. Bank has claim on your asset, right? You owe something to someone. That someone has a claim on your entity. Liability. So liability बोलते हैं कि कौन liability? Equity liability बोलते हैं कि debt liability. Liability. Normal liability. Yeah. All right. And also you need to provide information regarding transactions that happen during the period, right? And because of those transactions, your economic resources changed, increased or decreased. Similarly, claims can change. It can increase or decrease because of some transactions that you have done over the period. Provide information about those, right? So what we have covered so far? Okay, objectives. Okay, fine. The next content of the framework is qualitative characteristics. Framework basically identifies major 6 qualitative characteristics. Out of those 6, 2 are absolutely important. Those are called basic qualitative characteristics: relevance and faithful representation. And other enhancing qualitative characteristics, those are verifiability, comparability, understandability, and timeliness. Okay, timeliness. Very important. We need to memorize this. So what are the basic 2? Relevance and faithful representation. Never forget these 2, at least. Relevance and faithful representation. And 4 enhancing qualitative characteristics are right. Now let's talk about relevance briefly. An information is relevant if it has predictive value or conformity value. What value? Predictive value or conformity value. Then this information is relevant. What is predictive value? What is predictive value? Potential investors want to know in which direction company is going, whether share price is going to increase or decrease, what is the expected profit, right? Whether profit is increasing or decreasing over time, EPS is increasing or decreasing over time, right? Based on that, potential investors can predict the future, right? Future is relevant. Why that is relevant? You are providing money to this company today. If company grows, then you will get a return. If company falls in future, then you will lose. So future is relevant. So provide all those information that has predictive value that helps investors and potential investors to predict, right, in which direction company is going. That's why multiple years financial information should be reported in your reports, financial reports. Then conformity value. Shareholders, lenders, they have certain ideas about a company. This company is good, this company is bad, right? This company is going to earn like 100 taka per share EPS this year. This kind of ideas they have, general ideas. They are outsiders, right? Who are the insiders? Directors, managers. Now, when you provide information, their idea either is validated or unvalidated, right? Doesn't matter whether this validates or unvalidates, it has a conformity value. Clear? It confirms either you are right or wrong. Yeah. Basically, outsiders are having some ideas about your company, about your performance. They are outsiders, so they do not know everything. When you report the information, their ideas are either validated, okay, fine, your idea is good. I have guessed that the company is going to report 100 taka per share EPS this year. Right. Yes, it is 100 taka per share. Yeah, that can also have some conformity values, right? There can, of course, that is also important. That is also important because not all users will understand financial reports. Also, financial reports are limited in nature. That's why other information must be reported, right? Then material information, all material information are basically relevant information. Whatever is material, that is relevant, right? You guys have some idea of materiality from F8. Who can tell me when information becomes material? Because of what information becomes material? Who can tell me? Yes, that information is definitely material, right? And information can be material because of its size or because of its nature, right? Say, for example, director has committed fraud because of the nature. Your trusted director, maybe he was your friend once upon a time and you appointed that particular person as a director and he is stealing money. Maybe he has stolen insignificant amount of money. Because of size, it is not material. That insignificant amount of money doesn't matter to you. But he was a trusted director. He's stealing money from your company. This particular information, because of nature, material to you. Okay? Yeah, clear. Now, faithful representation. Right. So we are going to provide accurate information, complete information, and true information from a neutral position. Right. There can be influence, especially influence of the managing director, influence of the shareholders on you. accountant, right? Managing director will ask you to boost the financial performance, manipulate the account, but you need to be unbiased and neutral. Okay, unbiased and neutral. From unbiased and neutral position, you are going to provide accurate and complete and true picture. That is faithful representation. Also, you need to be careful about substance over form. Substance over form. Substance over form means there are basically two parts in this terminology. Form, that is the legal context. Form is what? The legal context of an element of a transaction. Say, for example, you are the legal owner of a piece of land. You, Rasim, okay? But Adnan is occupying that piece of land for 20 years and you cannot use that asset. So, what is the commercial context? Who is getting benefit from this land? Adnan. Adnan is a political leader and he is occupying the land for 20 years. You are not getting any benefit if you go to the land. He will beat you up big time. Right? So legal owner is Rasim. But commercially, who is using this? Adnan. As an accountant, what you are going to do, in whose book this land will be shown? In Rasim's book or in Adnan's book? Whose book? In whose book? In Adnan's book. Yes. That is substance over form. Right? Commercial substance is more important to an accountant than the legal form, legal context. Doesn't matter who is the legal owner, who is using it. Okay, good. So, commercial context. Okay, that is more important for accountants. Now, the next thing that we're going to talk about is prudence. Right. This prudence is not included in qualitative characteristics by the framework, but a special focus is given on prudence in the framework, right? It is basically, it is stated in the framework that prudence will ensure neutrality. Hence, it will ensure substance over form. Prudence will ensure what? Neutrality. Hence, what is prudence? Prudence basically means exercising a degree of caution when you are exercising your judgment regarding something uncertain, right? That is prudence. Example. So, for example, you have bought that air conditioning machine. What is the useful life of that air conditioning machine? You need to make a judgment. Yeah, 5 years maybe. From which source that information came? That information came from your judgment, right? It was uncertain, you made a judgment. When you make this kind of judgment regarding uncertain things, you exercise a degree of caution. You become conservative. That is prudence, right? The purpose of prudence is to ensure that your asset or income is not overstated. And your expense and liability are not understated, right? So you're becoming conservative. You're becoming conservative when exercising your own judgment. That's prudence. Clear? So what are the main two basic qualitative characteristics? Relevance, faithful representation. Relevance, what kind of information is relevant? Predictive value, conformity value, material. Faithful representation means accurate, complete, true, neutral, unbiased, substance over form. Accurate, complete, true, neutral, unbiased, substance over form. Right? Substance over form means examine commercial context. That is more important. Commercial context, that is more important. Prudence is important because prudence ensures neutrality. Here we're going to talk about enhancing qualitative characteristics. The first one is verifiability. You are disclosing an information. Make sure that you have supportive evidence, right? Auditor will come and they will ask for evidence. You need to provide some kind of evidence to support that information. You have evidence means this is verifiable. Clear? For some information, definitely you are going to have evidence. You have purchased something, you have invoice to show. Written document, no problem, submit that evidence. But there is some other type of information where you do not have that kind of evidence, right? So for that kind of information, we can still assess verifiability. If two or more independent, knowledgeable observer can conclude the same thing regarding one particular item, then we consider this is verifiable, right? For example, I'm no friend with Ukil. Resim no friend with Ukil. Adnan is not friend with Ukil. We are all independent. We are knowledgeable observers. We have concluded that Ukil is a good buy. It's verifiable. What is the useful life of this air conditioning machine? We do not have written evidence. He said 5 years. I said, oh, 5 years is reasonable. Resim is saying 5 years is reasonable. It's verifiable. Clear?
Yes.
Nice. Now the next enhancing qualitative characteristics is comparability. Yeah, what's your condition? Question.
Relevant for material information. Relevant material information. Relevant material information.
Material information is always relevant.
Material information क्या माने material की ना उसे की verify करते हो सब समय.
Yes, you need to assess whether that information is material or not. We have a practice statement on materiality also. No, we have different practice statement here in SBR for materiality. Okay, now comparability. For comparability, we need proper disclosure, right, and consistency. Why disclosure is important? Because different entities can use different accounting policies to measure same type of items. I have air conditioning machine, you also have air conditioning machine. I am using a policy, historical cost for measurement. You are using fair value for measurement, right? So I am not revaluing my machine, you are revaluing your machine. That's why figures are significantly different. Those are not comparable unless we provide disclosure of the significant accounting policies, right? Yeah, yes, estimated useful life, residual value, disclose those. Then it will be comparable. Right? Then let's talk about consistencies. We need to apply same kind of accounting policy year to year. This year I'm using historical cost accounting basis for my machine. Next year I should also use historical cost accounting basis for my machine. However, we can change it, no problem. It is allowed to change. But if we use or apply same policy year to year, then it ensures consistency. So my financial statement of last year is comparable with my financial statement of this year. Because both year I have followed same accounting policies. Now, inventory measurement. What are the measurement basis for inventory? Who can tell? FIFO and AVCO. LIFO is not allowed. So FIFO, AVCO. Last year, you have measured your closing inventory using FIFO basis. This year, you have decided to apply AVCO. What you need to do? What is the guideline? Who can tell? Retrospective effect. That's very good from F7, right? You already know. That means this year you are applying AVCO. You need to restate last year's financial statement and show measurement based on AVCO basis, right? So both here AVCO. It is consistent, it is comparable. Clear? Understandable. Similarly, same accounting policy for similar type of transactions or elements. Clear? Now, understandability. For understandability, we need proper classification and presentation. A standard classification and presentation. Similar type of items are grouped together under a particular class. And standard classifications are non-current assets, non-current liabilities, current liabilities, equities, right?
Yes.
Property, plant and equipment, inventories. These are standard classification. Also, we are going to prepare financial statements following standard formats. Then it will be more understandable. Sometimes disclosure is required to ensure understandability. Without disclosure, some information may not be understandable. Disclosure will help you over there. Then timeliness and cost constraint. Cost constraint. What is cost constraint?
project,
Like you are preparing financial information, it has a cost. If your company is small, you cannot afford like 3, 4, 5 ACCA members. It will be very expensive for your company, right? Cost is higher than the benefit of producing that relevant information. Do not do that. Okay? Stay within the cost. That is cost constraint. And timeliness, you all understand that. Okay, clear, guys? Okay, nice. Now, financial statements. Objectives of financial statements that is identified by the framework. Why we prepare financial statement? What is the objective? Once again, the objective is to provide information to our potential investor and potential investors. This time, what kind of information we are going to provide? Information so that they can assess, financial information of course, information so that they can assess future cash flow prospect. What is important? Cash flow, future cash flow prospect of the entity. Also, so that they can assess management's stewardship over the company's assets. Two things are most important. What are those two things? Management, stewardship, and future cash flow prospect. Provide information so that users can access those things. Clear, guys? Very good. Two statements are prominent. Those are mentioned in framework. However, we produce many other types of statements. These two statements are the statement of financial position and the statement of financial performance. Very important, most important. These two statements are most important. Now the next thing is reporting entities. Framework doesn't provide or identifies specifically which entities should use this framework to prepare financial reports. Right? Rather, it provides general description, and based on that general description, any types of entity can prepare financial reports following this framework. It can be a company, it can be partnership, sole trader, association, all kind of entities, right? However, it provides some boundaries also. Now, the next content of the framework is elements. Yeah, these are the elements. Open a statement of financial position, you find asset, liability, equity, A statement of financial performance, you find income, expense. Fine. Now, framework is going to provide you definition for each of these elements, and this definition is very important. You need to memorize these definitions. Okay. Now, the first definition is for asset. What is an asset? Asset is a present economic resource controlled by an entity arising from a past event. So what are the things of this definition? Present economic resource. Present right now, you have it. Economic resource, control, and it has arisen from past event, right? So what are the elements of this definition? Economic resource, you have control, arising from past event. Now, it also defines what is economic resource. An economic resource is a right. It is what? Right, with potential economic benefit. Right with potential economic benefit. That's it. It can be a physical asset. It can be non-physical also. Example of asset. Someone give me an example of an asset. Huh? Example, any example of asset? Yeah, building is a physical asset. Right, fine. A building will be your asset if certain conditions are met. What are those conditions? It is already economic resource. You need a present control over this arising from a past event. That means maybe you have purchased it, or somehow Adnan has occupied that land, maybe.
Long-term lease long-term lease long-term
Yeah, no problem, no problem. You do not have ownership, doesn't matter.
So, কোনো কিছু license
Yes. It can be asset also. Now here we have quiz. Let's check whether you can answer this. Which one of the following attributes is not considered for identifying assets of an entity? Oh, already. What is the answer, everyone? Okay, it was very easy for you, no? Okay. Now, next, liability. What is the definition of liability? This is a present obligation. Right now, you have this obligation to transfer economic resource as a result of past event. Present obligation to transfer economic resource as a result of past event. Example of liability, guys.
loan.
Yeah, you have taken a loan. Already taken. That means you have present obligation to transfer what resource? Money. Right? Fine. You have a factory. You have recently constructed that factory, right? You will produce goods in that factory, but operation didn't start yet. Operation of that factory will pollute the environment, and government has environmental legislation. Under that legislation, if environment is polluted, you will have to pay fine. If environment is polluted, you will have to pay fine. Okay? You have just constructed that factory, operation didn't begin. Operation surely will contaminate the land or air or water, that means pollute environment. Tell me whether you have a liability or not. You have a liability?
Contingent. So, provision create করতে হবে না?
Anyone else?
So question
Right, that's the point. Right. You have just constructed the factory, operation is not started yet. That means environment is not polluted yet by your factory. That means you do not have any present obligation to the government. Right? Nothing arisen from past event. You didn't pollute, so you are not bound to government. Not right now. No present obligation. So you do not have liability. Equity, this is very simple. This is residual interest of the owners on the assets of the company after deducting all the liabilities of the company. That's simple. Equity. Very simple. Residual interest of the owners on the asset after deducting all the liabilities. Now, income. What is income? Income is either increase in asset of the entity or decrease in liability of the entity that increases the equity of the entity. So there is a compulsory condition that increases equity. That is the compulsory condition. It is either increase in asset or decrease in liability. Compulsory condition is equity must be increased. If you have income, equity must be increased. However, we have an exclusion other than contribution of the equity participants. That means if you issue equity share and if you get some money, share capital credit, that is not income. Right? That is excluded from this definition. Equity is increasing by issuing shares to the shareholders, equity share capital credit, that is not income. So what is income? Increase in asset or decrease in asset liability. What is the compulsory condition? Compulsory. Nice. Then expense is just opposite. Awesome. Increase in liability. What is the compulsory condition? Decrease in equity. We also have an exclusion over here other than distribution to the equity participants. Example, dividend. You pay dividend, so retained earning debit, retained earning reduced, equity reduced, but this is not an expense. This is excluded from the definition. Now let's talk about recognition criteria. This is previous recognition criteria you check at home, right? Increase, decrease, inflow, outflow probable, reliably measurable. That was the recognition condition previously. Now we have recognition and derecognition guidelines, not criteria exactly, but guidelines under our current framework. First thing first, in order to recognize an element, it must meet the definition provided by the framework. If it is an asset, it needs to meet the definition of asset. If it is liability, definition of liability, income, expense, right? Clear? Then two things are very important. That is qualitative characteristics. Which two are most important qualitative characteristics? Relevance and faithful representation. You need to ensure you are recognizing something that produces relevant information and faithful. It ensures faithful representation also, right? So it has predictive value, conformity value, or it is material. You are providing accurate, neutral, unbiased, complete, true picture. You are following substance over form. In order to be neutral, you are also exercising prudence. Very important, right? So these are the basic guidelines. Also, it focuses on cost constraint. That means benefit should outweigh the cost of recognition. If you spend too much money for valuation of an asset, not good, right? Shareholders will suffer. Clear, guys? Now, derecognition guidelines. So, for example, what kind of example I should give? You had land, 20-acre land. You have sold like 5 acres land. You still have 15 acres land. So you need to derecognize 5 acres. Right? We have a guideline. You have something remaining, 15 acres. Right? Show that, ensuring faithful representation. And there is something decreased, 5 acres gone. Right? Record that, ensuring faithful representation. So faithful representation should be ensured for both the remaining portion and for the decreased portion. Right? Clear? Understand?
Yes.
Awesome. Now, next, measurement basis. Basically, 2 different types of measurement bases are discussed in the framework. Number 1, historical cost basis. You all know what is that. And current value. Right? Current value, it may mean many things, like fair value, value in use, current cost, right? You know what is fair value?
Yes.
In simple term, this is the market price. Yeah. What is value in use?
I mean, bill quoted that you pass the bill.
Yes, if you use this asset, how much benefit you are going to receive from this asset, that is value in use. What is current cost?
Like
Yeah.
replaceable.
Right. Replacement cost, say for example, in simple terms. Right. Now you need to choose between these things for your item or element. You have an asset. For that asset, you do not have like any IAS IFRS in the world. Maybe this is different weird kind of asset. You need to measure this asset, go to the framework because no IAS IFRS is available. What you find in the framework, choose between historical cost or current value. Which one is to choose? You need to make this decision based on certain things. What are those things? Objective, qualitative characteristics, and also consider cost. Right. Objective, qualitative characteristics, and also consider cost. Weird type of asset. I have seen like there are some Saudi people, then Middle East guys with turban and big white dress. Right. They have pet tiger, pet lion. So yeah, we are type of asset. So how to measure?
বায়োলজিক্যাল অ্যাসিডে পড়বে হারভেস্ট করতে পারবো
Okay, now presentation and disclosure. Right? Now, the framework basically identifies 2 most important financial statements, and those are a statement of financial position and a statement of financial performance. We have issues regarding a statement of financial performance because framework doesn't tell you whether that statement of financial performance should be single statement or 2-part statement. Right? It can be 1-part statement, it can be 2-part statement. Historically, this statement was known as income statement, and it was 1-part statement. Then it had different name, a statement of comprehensive income, and it became 2-part statement, a statement of profit or loss, a statement of other comprehensive income. Now again, it changed to a statement of financial performance. Now the question is whether it will be 1-part or 2-part. No guideline is available. Right? Follow your practice. Whatever is established practice you are doing, accountants are doing, do that. Okay. Now, we see some emphasis over here. Right. Framework says that income and expense should be reported in profit or loss. Right. but some exceptional items can be reported in other comprehensive income. Now, what is profit or loss? That's the next question. What is other comprehensive income? That's the next question. Unfortunately, no definition is available. As there is no definition available in the framework, we do not know, right? What is profit or loss? What is other comprehensive income? So what items should be put in profit or loss section? What items should be put in other comprehensive income section? We do not know that from framework, right? There is basically a long outstanding debate going on which items should be put in profit or loss, which items should be put in other comprehensive income. There are two parties, both parties are equally strong, so there is no conclusive decision on this matter, still, no decision. It is pending, forever pending. Now, when you have IAS IFRS for your particular element, financial instrument IFRS 9 is available. Check the guideline of IFRS, right? For financial instrument, mostly profit or loss. But there are other comprehensive income, fair value through other comprehensive income financial instruments also. So it specifically tells you which item will go to other comprehensive income, which item will go to profit or loss. You do not have any problem. You do not need to come to framework. But for a particular transaction, if there is no IAS IFRS, what to do? We do not know. But focus is given on profit or loss in the framework. So put it in profit or loss. Put it in profit or loss. Next thing, concept of capital. Framework basically identifies two different types of capital. Those are financial capital and physical capital. Financial capital is easy to understand. This is measured in money terms. I have 10 crore financial capital. 50 lakh equity financial capital. 10 lakh loan financial capital measured in money terms, right? And physical capital, that is not measured in money terms, rather that is measured in operating capacity. Example, anyone?
Mobile tower.
Oh yeah, tower, fine, awesome, awesome. Satellites, how many satellites Google has? Maybe 10, 15, right? Bangladesh has one satellite, awesome. Physical capital. How many towers Grameenphone has? How many customers, right? Ongoing connection, SIM connection, Grameenphone has. That is operating capacity. How many factories do you have in different locations? That is operating capacity, right? In how many countries Unilever is doing its business? Operating capacity, that is physical capital, right? So business is not only made using money, you also need operating capacity or physical capital, right? So like if I give 50 lakh taka to Rasim and 50 lakh taka to Adnan, two different persons will make two completely different business because their physical capital will be different. Someone will make good profit, someone will make less profit because their physical capital different. Yeah. Now, there is an issue with physical capital. What is that issue? Inflation. Right? Because of inflation, what happens? Purchasing power of your money will increase. So 50 lakh today and 50 lakh after 5 years, not same. I have given 50 lakh to Rasim today. If he maintains 50 lakh capital, he's maintaining financial capital for 5 years. But I will be extremely dissatisfied. I'm the shareholder. Will be extremely dissatisfied if I find 50 lakh from Rasim in equity after 5 years. Because the value of 50 lakh is less after 5 years. So what Rasim needs to do over these 5 years? Yeah. Rasim needs to make this 50 lakh to 60, 70 lakhs. Right? Say, for example, Resim has purchased a machine using this 50 lakh bread making machine from China. The price of that machine today is 50 lakh. After 5 years, because of inflation, that machine is fully depreciated. It cannot make any more bread. Now Resim needs to replace this machine. Resim depreciated that machine. That means Resim had created accumulated depreciation allowance of 50 lakh. No problem. Right. So Resim has 50 lakh in his hand. But using that 50 lakh, Resim will not be able to purchase a new machine after 5 years because price of that machine has risen. Now it is 70 lakh in the market. So Resim cannot maintain its physical capital, right? Operating capacity. Resim needs to shrink the business. Now Resim will do what? Employ people to make bread by balloon and key. Yeah, machine will not be available for us after 5 years. So you need to do what? Retain profit, right? Make profit and retain that profit, make it 60, 70. Also, revalue that asset. If Resim revalues that asset to 70 lakh, his cost is 50, but if he revalues that asset to 70 lakh, what will happen? Accumulated depreciation allowance after 5 years will be 70, not 50. So, Resim will be able to replace this asset after 5 years. Do you understand this concept?
Yes.
Right? That is what you are going to do to maintain physical capital of your entity. Now, finally, we are going to talk about significance of framework and IFRS. Most important significance of this framework is it avoids firefighting approach, haphazard approach of standard preparation. If we do not have framework, then standards will be prepared following firefighting approach. That is a haphazard approach. What is firefighting approach? That is reactionary approach. That is something terrible, mistake, wrong has already happened. Right. Your factory is burned by fire, then you are calling fire service. That is firefighting approach. What is the good approach? Proactionary approach. Take fire prevention measures upfront, right? That is proactionary approach. So you have framework means you have proper plan, resource allocation, right? And you can avoid firefighting approach of standard preparation. Example of firefighting approach, IFRS 9 basically was prepared under firefighting approach. After USA financial market collapse, right? UK also suffered, many other countries also suffered because of that recession that was pervasive in nature. Right, after 2007, 8, during that time. IFRS 9 is prepared immediately. They are seeing our existing IFRS is not good enough. Not good enough, right? Companies will collapse if these kind of things happen again in future. Right? They prepare this IFRS 9 under firefighting approach. Now, the next set of importance of framework. We have framework means the basic elements are tackled in one particular place. What is the definition of asset? We have many IFRSs on assets. IAS 16, PPE. IAS 40, biological agriculture. Correct. IAS 2, inventories. right? IAS 41, yeah. IAS 40, investment properties. IAS 38, intangible assets. We have many IAS IFRSs on assets. But we do not need to provide the definition of asset in every single IAS IFRSs. In one particular place, it is handled. It's good. If all these different IAS IFRS provide their own definition of asset, maybe it will be inconsistent. Different IAS will define asset in different way. It will be contradictory and conflicting. No need. It's good if we have a framework, right? And this framework is principle-based, so it is good for us, right? Principle-based framework is flexible. It's flexible. We are not bound tightly, right? But if we do not have this principle-based framework, what may happen? Rules and regulations may come to discipline accountants. Right? It will be necessary, but we are following principle-based framework, so good. What happened in USA? Basically, it's rule-based, mostly rules-based, right? Big shot. Okay. Okay. Good. You guys also watch this kind of movie. Then without framework, there will be misinterpretation bias. Easy to understand. Okay. Now we are going to talk about limitations of IASB framework. The first limitation, it doesn't provide a specific guideline for a specific transaction, specific items. You have a cow, right, or a goat. How to measure that? Framework doesn't provide a specific solution for a specific transaction or item. It provides basic thing, overall thing, right? Now, this is theoretical in nature and it cannot solve all of your practical problems. You will have different types of transaction of cow, transaction of goat, food, right? Banking transactions. You have different IAS IFRS for that. Framework doesn't provide solution for all those things. Individual IAS IFRSs are required. Okay, clear guys? Now the next limitation of the framework, IASB framework, this is almost global in nature. Most of the countries of the world are following this framework. Also there arises discussion whether this one single framework is suitable for all the countries, for all the industries, all the companies. Right, there can be many different types of industries and companies. They may have different types of transactions. Right. There can be country context. Some of the companies may not like this framework. Right? Not everyone likes to eat dal every single day. Maybe you like, maybe I like to take dal. That is the common thing in our daily food. We eat dal every single day, but may not be suitable for everyone. Huh? Yeah. That's the issue, right? So this framework is like dal, truly global, in everyone's plate, but you do not like it, right? There can be some different companies and people and countries different like it, not suitable for everyone. Hey, then this framework is limited, incomplete. You understand that, right? Yeah. And it has other limitations. It doesn't fulfill users' requirement, right? Day by day, users' demand is growing. This is the age of information, and users have many demand for information. They want to know a lot of things about company. Yeah. Framework is providing or encouraging you to disclose information about the economic reserves of the company, claim increase, decrease in economic reserves. But users also want to know how you are using that resource to generate value. What is your strategy? Okay. Users want to know that. Right. Users want to update on Facebook on regular basis. What you are doing. Right. This is the age of information. So framework doesn't provide this. does it provide this? Right. What is the strategy? How resources are used? How values are created, etc., etc. Right. So that's the limitation of framework. This is mostly historical, profit or loss focused. Right. For modern days, we need different type of things. We need to update these frameworks also. Now, harmonization, there is some little bit information regarding harmonization. That means IASB, FASB, they are working together. This is very good. Then they will prepare one set of a standard that will be truly global. All the countries will follow this, right? If you become ACCA member, you will get job in UK, also in USA. Now you cannot get a job in USA, but then you will get a job in USA also because they are also following the same framework. That's the hope, na, for future.
Gap and text are followed. Gap and text.
Take CPA if you want to move to USA, but later you will hopefully it will be much easier for you if they harmonize things, work together a lot. Let's see what happens in the future. Then harmonization across European Commission, right? For listed companies, consolidated statements already prepared in European countries following IAS IFRS. This is good news for you, right? This is mandatory over there, especially for consolidated statement listed company. It is mandatory over there. So it's good news for you. You are learning ACCA means you are learning SBR, international variant. What variant? International variant. You are learning IAS IFRS. You can migrate or transfer your skill over there in European countries. We're going to talk about advantages of IFRS. IFRS, advantages of IFRS, International Financial Reporting Standards. If we think IFRS are also like DAL as like framework, right? Common menu in everyone's plate. Almost global, maybe. Some of the countries do not follow IAS IFRS like USA and other countries, but almost global, right? Then what are the advantages? It will be advantageous for the multinational companies because they will have subsidiaries or operations in different countries. For all those countries, you need to prepare financial statements, and you prepare financial statements following one set of standards, IAS IFRS. Maybe in head office, you have a boss. He can handle all those things because he knows IAS IFRS. He doesn't need to know 10, 15 financial reporting standards. That's easy for him, right? Not difficult. The stock exchange listing, many big companies obtain stock exchange listing in different places, DSE, CSE, other London Stock Exchange, right? They issue shares in multiple stock exchanges, and the stock exchange will require financial statement from you, right? If all the countries are following IAS IFRS, fine. Prepare financial statement for all those stock exchanges following one single set of standards. Easy. Maybe currency will be different, so ultimately we'll have to prepare different currency financial statements. But at least you are following the same standard for all those stock exchanges, right? Group companies, you need to prepare consolidated statement. You have subsidiary in Bangladesh, Pakistan, China, Bhutan. Everyone is following IAS IFRS. All those statements, individual statements, are based on IAS IFRS. Now you need to combine, no problem. Right? But if someone is following IAS IFRS, someone is following BAS, then it's difficult for you to combine these things. Answer?
IKB করে দিয়েছে যেটা ম্যাটেরিয়াল সব একই স্যার সব IKB করে দিয়েছে IFRS কে BFRS করে দিয়েছে
Right. So same standard means easy to prepare consolidated statement. Different standard means, oh my God. Right. You need to divorce your wife and also kids if you are group CFO. Right. You can also apprise foreign companies' performance, compare your company's performance with foreign companies' performance, etc. Now, these are other general advantages of IAS IFRSs. Confusion, variations, these are reduced. National standard setters like Bangladesh, they want to prepare PFRS, BASH. They can just copy IAS IFRS. Is it right? Workload is reduced significantly. Just copy those. Yeah. Bangladesh follows IAS IFRS, right? This is. We have intelligence. We have people to do this, right? We have money, right? So, like, why we will not take this prestige? So we will not use it. Like we are sending satellite, big satellite with surplus capacity. We will not be able to use it, but we have money. Why we will not take that prestige? Yeah, big satellite, right? Though we are not going to use full capacity of that satellite, right? Oh. But we have the prestige. Prestige, we have done it. Finally, no? Then we are producing data center. Asia, largest in Asia data center in Bangladesh. Nothing to do with that. In Kajipur. Nothing to do with that. We cannot use that ourselves, we cannot rent it out. But we are doing this. Prestige. Okay. So we do this for prestige. Encouragement. Now, next, difficulties that are faced by IFRS. Once again, same difficulties that are faced by framework. One single set may not be suitable for everyone. Right, this is the common thing, common menu in your plate, but you do not like it. Not suitable for all companies, not suitable for all countries, maybe for all kind of transactions. Right, that's why there are significant lobbies, pressure groups sometimes in some countries against IAS IFRS. They do not like particular IAS IFRS because this is too tough, because they need to disclose a lot of information. They do not want to do that. They want to steal some money, right? Avoid some tax, but steal shareholders' money. But if they need to follow IAS IFRS, this is going to be really difficult and painful for those companies. So what they will do, they will go to Bangladesh government. We need our own IAS IFRS, right? Bash, make it easy little bit. Right, give option. If you like, you can follow IAS IFRS. If you like, you can follow Bash. So there is significant, this is a fact, right? Powerful companies lobby with government for easier solutions, right? So you will prepare your own IAS IFRSs. Your country will make, not maybe full, but some IAS IFRSs will be made. So you can use that. Okay. And another problem, many IAS IFRSs are not based on local, not IAS IFRS. IAS IFRS, those are based on conceptual framework, but local standard may not be based on conceptual framework. So there can be significant inconsistencies. Okay. So that's it for today. Now, if you have any question, you can ask me question right now.